Today we're going to talk about a swing trading strategy for the S&P 500 that over the last 2 decades has delivered twice the total return of the index while beating the market only 29% of the time. The strategy also works for the NASDAQ 100, the Russell 2000, several different sector indices, and dozens of country indices. Now, first, let us say that this is for informational purposes only, it's not investment advice, and past performance is no guarantee of future results. With that said, why has this strategy worked so well for the S&P 500 and related assets over the last several decades? Well, it all comes down to one characteristic of global equity markets, and that is they tend to be mean reverting. So what is mean reversion? Well, mean reversion is the opposite of momentum. So in a momentum-driven market, up days tend to follow up days and down days tend to follow down days. Mean reversion is the opposite. Up days tend to follow down days and down days tend to follow up days. Without this characteristic, the strategy that I'm about to show you would not have been as effective for global equity markets. Now, the S&P 500 wasn't always mean reverting. In fact, for most of its history, it was momentum driven. But at some point in the 1990s, the mid to late 1990s, it made a shift from being momentum driven to being mean reverting. And it's been mean reverting ever since, and strongly mean reverting. So that is the primary reason why this strategy has worked so well. Now, if that characteristic of the index goes away, then the effectiveness of this strategy will likely also go away. So keep that in mind. So what is the strategy? Well, here we have an intraday chart from Thursday, January 4th of the S&P 500 ETF SPY. It's a 1-minute chart. And on this chart, we can see that the low on Thursday, January 4th was 467.05 and the high was 470.96. The close on Thursday was 467.31. Now, the lower 10% threshold of that low to high range was 467.44. And we can see that the S&P 500 closed below that 10% threshold. Now, this indicator that we're looking at, it measures where the asset finishes within its low to high range on a given day or over multiple days or weeks. In this case, we're looking at 1 day. So it's referred to as the 1-day stochastics. And the strategy is simple. It's this. If the asset that you're looking at, in this case, the S&P 500, finishes within the lower 10% of its daily range, buy at the close and hold until there are 3 consecutive days in which it does not finish in the lower 10% of its daily range. Now, and on that third day, you would exit at the close. Now, some might say, well, if I have to wait until 4 o'clock to see if it finishes in the lower 10% of its range, how would I then buy it? Well, that's a great question. So there are several ways you can handle this. One is if you're looking at the S&P 500 or the NASDAQ 100 or the Russell 2000, you can simply place your trade in the futures market. The futures market stays open until 5 p.m. Eastern, so you can wait until 4 p.m., see if any of those assets close in the lower 10% of their range. If so, you can place your trade in the respective futures market. Another way you can handle it is by monitoring whether or not the asset is in the lower 10% of the daily range up until 10, 20, 30 seconds left in the session, and then place your order accordingly. And lastly, if you're trading large liquid ETFs, you could wait until 4 p.m., see if it finished in the lower 10% of the daily range, and then place an order after hours. So SPY, GQQ, IWM, they tend to have tight bid-ask spreads in the aftermarket hours, and one could affect trades in those assets at that time. So that's how you could potentially execute this strategy if it were something that you were interested in. Now, let's see how the S&P 500 performed based on this strategy. So here we have the 1-day stochastic strategy with a 3-day window, meaning that the S&P 500 can't close in the lower 10% of its range for 3 consecutive days. If that happens, you exit on the 3rd day at the close. So the black line here is the buy and hold return, where if you had invested $1 at the inception of SPY, you would have ended up with $18.86. The blue line is the strategy, where we take every trade. And this strategy, if you had invested $1 at the inception of SPY, you would have ended up with $35.67. You would have been in the market 29% of the time with a Sharpe ratio of 1.9 and a maximum drawdown of 21%. 35.6 is roughly double 18.86. So you're getting roughly twice the return of the S&P 500 in only 29% of the time. Now the red strategy is if we only take The mean reversion strategy trades when the S&P 500 is above its 200-day moving average. You can see that didn't fare that well because many times when the market finishes in the lower 10% of its daily range, it happens to be below the 200-day moving average. So you're missing out on some beneficial trades. The green line is if we only take the mean reversion strategies trades when relative sentiment is bullish. Now, what is relative sentiment? Relative sentiment is a measure of how institutions are positioned in the market relative to retail traders. Institutions tend to have better outcomes. So if they're more bullish than retail traders, that tends to be beneficial for equities. If they're less bullish than retail traders, that tends to be unfavorable for equities. So here we're only taking the trades when institutions are more bullish than retail traders. And as you can see, $1 invested in that strategy would have turned into $19.47, which is roughly the buy and hold return. But you're only in the market 20% of the time with a Sharpe ratio of 2.6 and a maximum drawdown of 15%. So in this sense, it's a quite efficient strategy. Now, as mentioned, it doesn't work only for the S&P 500. Here we'll show some other similar charts. Here we see for the NASDAQ 100, you're getting twice the return with either the unfiltered strategy or the relative sentiment filtered strategy versus the buy and hold strategy, while being in the market 30% of the time, 20% of the time, respectively, with much lower drawdown and much higher Sharpe ratios. For Japan, similar story. The buy and hold return didn't return much. $1 would have turned into $1.45 after almost 30 years, whereas the unfiltered mean reversion strategy would have turned into $8.70, and the relative sentiment filtering strategy would have turned into $5.70. Similar for developed markets, you're getting about 1.5, 1.6 times the buy and hold return, while being in the market a fraction of the time, lower drawdowns, higher Sharpe ratios. Same thing for emerging markets. Here, the unfiltered strategy returns 2.5 times the buy and hold return, whereas the relative sentiment strategy is giving you a little bit more than 1 times the buy and hold return. Both are in the market, a fraction of the time as the buy and hold, with higher Sharpe ratios and lower maximum drawdowns. Now we can look at a table of different country indices and different U.S. broad market indices. We can look at the unfiltered strategy and its time in the market. We can look at the unfiltered strategy and the multiple of the buy and hold return that it delivers. We can do the same for the relative sentiment strategy. The red cells indicate where the strategy did not at least equal the buy and hold return. So if we look at the aggregate statistics, we can see that across all of these different equity indices, the unfiltered strategy on average was in the market 32% of the time, and on average delivered 2.5 times the buy and hold return. The relative sentiment strategy was in the market 22% of the time, and on average delivered twice the buy and hold return. Not bad, that's fairly efficient. Now, what happens if we hold this for 4 days instead of 3 days? Does the effect go away? Well, actually, no, it gets stronger in many cases in the aggregate. So if we look at 4-day strategy for the S&P 500, again, the buy and hold return, $1 would have turned into $18.86 over 30 years, whereas the unfiltered strategy, mean reversion strategy, would have turned into $45. So that's like 2.5 times the buy and hold return. The relative sentiment filtered strategy would have delivered twice the buy and hold return while being in the market only 26% of the time. So the effect doesn't go away by holding it for 4 days. And we can look at the aggregate statistics. We see that here we're in the market now on average 40% of the time, but we're returning 3 times the buy and hold return. The the relative sentiment filtered strategy is in the market 28% of the time and is returning 3.1 times the buy and hold return. So it's in the market on average much less than the unfiltered strategy, but is returning more, which suggests that the longer you're exposed to the market, the more beneficial it is to filter by relative sentiment. Now, what happens if we look at a 5-day holding period? Well, that's where the effect starts to diminish. So now we're in the market on average 47% of the time, but we're only returning 2.5 times the buy and hold return. No, that's pretty good. You're in the market half the time and you're still returning 2.5 times the buy and hold on average. But we were returning 2.5 times the buy and hold on average with a 3-day window as opposed to a 5-day window. So here we're in the market 50% more of the time, 47% versus 32%, but we're not returning anymore. So you can see that 5 days you start to get diminishing efficiency. We can also look at sectors for the 3, 4, and 5-day. Sectors don't perform as well as broad market indices for countries in the US. You see there's more red cells where the strategy doesn't at least equal the buy and hold returns, but nonetheless, you're in the market for the 3-day hold 31% of the time. For the unfiltered strategy, you get 1.5 times the buy and hold return. Relative sentiment strategies in the market 22% of the time, you get 1.6 times the buy and hold return. For 4 days, you don't get anything on the unfiltered strategy by being in a fourth day with sectors, but you do get a pickup in the multiple of the buy and hold return for the relative sentiment filtered strategy. And again, for 5 days, you don't get anything for the unfiltered strategy by being in the market that extra amount of time. You get a little bump up in the relative sentiment strategy, but it's probably not worth the extra time in the market, which leads to higher maximum drawdowns and lower Sharpe ratios. So it looks like the sweet spot is 3 to 4 days for the holding period. Now, this signal triggered on Thursday, and today we're 2 days into that trade. It did not finish in the lower 10% of its range on Friday. It did not finish in the lower 10% of its range today. In fact, it finished in the upper 10% of its range. So if tomorrow it doesn't finish in the lower 10% of its range, if you're trading the 3-day window, one would exit the trade. So that's the strategy. I hope you enjoyed it. I hope you learned something. And until next time, I wish you the best. Thank you. Thanks for watching. If you enjoyed that clip, follow for more. To get weekly updates, sign up for my free newsletter at relativesentiment.com.